China's factory gate inflation to its highest since 2008. Next up, US CPI. The crypto collapse continues. Bitcoin slips as strategists see more pain ahead. And in fashion, sales and net income from Zara owner Inditex beat expectations as economies reopen. May sales top 2019 levels. Welcome back to the programme, everybody. The second hour of the European market open. 20 seconds to go until the start of the European cash trading session. And European equity markets looking in aggregate fairly flat. Could see a little bit of upside in Paris, a bit of downside in London, but overall not anticipating huge moves. Yesterday's session dominated, well, ending at least with a fairly flat outcome on both sides of the Atlantic, fairly mixed outcome. So we've got inflation on the mind, certainly, when it comes to the Chinese story, China putting in place some attempts to control certain elements of the consumer prices in that country. Factory inflation very much to the fore, as we have a number of 9% or so in terms of the factory gate inflation this morning coming through from China. And as we mentioned in our headlines, the focus on US inflation as well. Now, European equity markets then just opening up this hour. Let's have a look at where they have opened. As we said, expectations fairly flat, really. And that's what we've got. The Stock 600 fairly flat this morning. The FTSE 100 down by 0.25%. The CAC 40 up by 1/8. The Xetra DAX fairly flat. So as we all sort of limbo, waiting, languish in this sort of area. Not a bad place to languish, though. Global stocks not far from all-time highs. We're waiting for a further print on inflation, another bit of guidance, a piece of the jigsaw on global inflation to come out of the US tomorrow. So with all that in mind, European equity markets not going very far. Investors are looking ahead to that inflation data from the US, which may affect views on the likely timeline for any Fed taper talk. We're joined now by Simon French, Chief Economist at Panmure Gordon. Simon, a very good morning to you. So we've had this China factory gate inflation. A lot of people point to the links between that and consumer prices elsewhere in the world. When you see such strong inflation coming out of China, more than 9% this morning, is that a signal that we need to upgrade expectations for inflation in, say, the United States, or is the link not quite so direct?
Well, it's not a direct read across, but undoubtedly, whenever you get a print or producer price indexes out of China, which has been the real driver over the last...
Hope you're doing okay today. Are you ready to place a trade? I'm looking to trade euro and I'm looking to buy euro at 121.797. Okay, here is your chance to buy at 797, but it's not yet, we didn't open yet position, so order placed at 121.797, as you can see. Because we trade on margin and we place large orders, this is common sense that it will jump away until our order will find buyers, right? So let's see, hopefully it will get filled right now. If you're looking to trade today euro, here is your chance. You can place order, stay with me, and we will go through this together trade until the end. Okay, I'm still waiting for our order to be filled. It equals several £100,000, so probably I'll try to, let me see, I'll try to move a little bit lower. Maybe I will try to put a little bit lower. Maybe I will be able to fill at this level. 121,796. Let's see. I gave more room to smaller orders to be filled, or maybe somebody wants to buy a larger order and they don't want to spend straight away large amount of money on one order. Okay, I'm still waiting. If you want to get the strategy, you can go to companyi.co.uk. You can get the strategy. For our clients or for people who know what we're doing, you can start trading. You see what we're doing and you know exactly what to do in this case. Okay, it moved away. I will wait for a couple of minutes, for a couple candlesticks. I will see what's going to happen later. I'll speak to you later. Stay safe.
2.5% mark. Is this the point at which the Fed should start to bring forward some of their tapering narrative? But of course, what we've heard from the Fed of late has been about how they don't want to see expectations of inflation. They actually want to see the reality of inflation. So how much should we think about expectations priced into market at this point? What is the meaning of those when the Fed is so focused on outcomes?
Well, we need to see expectations within the context of the flexible average inflation target, or FATE, what was unveiled last year at Jackson Hole by the Federal Reserve. There is a catch-up period of both above target inflation in terms of the actual prints, but also above target inflation expectations, because, of course, for the last 5 years, US PCE inflation has largely undershot, and policymakers are very, very focused not just on returning the US economy post-pandemic to a rude level of health and full employment, but also making sure that an inflationary bias to the downside doesn't set in. It's a very aggressive mandate, and therefore I think they're quite comfortable.
Okay, day traders. Okay, guys, position opened on euro at 121,796. That's a long position. Okay, you still have time. It moved lower. Stay with me. If you want to get the strategy, you can get the strategy on companyi.co.uk. Otherwise, follow my trades. If you want, you can copy them. No questions asked. It's free. We don't advise. We don't give you recommendation what to buy. We have many screens, so we trade all major forex markets, indices, stocks. But we show you only one screen. If you want to trade other instruments, you have to get the strategy, and it's all explained over there. You will trade other instruments if you decided not to follow trades, if you decided to trade other forex pairs. I'll speak to you later, guys.
A little higher, not necessarily pegged to that news, as this
or a country basis and provide either a passport scheme or a set of regulations within that geographical area, either country specific in the UK and US or continental in the case of the EU. But the virus is no respecter of what parameters you introduce. And there is potentially a weak underbelly because of the amount of global travel that will take place. And the idea that you can segment out individuals and countries, I think, is still a bit optimistic. I remain cautious on this sector, not because things will get better, things will get better, but the idea that the vaccine passport could be a golden bullet to unlock the summer travel industry, I think is over-interpreting the impact of a pandemic passport.
Simon, thanks so much for your time. Good to speak to you. Simon French, Chief Economist at Panmure Gordon. Thanks for spending time with us this morning. Now, coming up on this programme, China's new 7,500-mile undersea data cable. But should the world worry about data risks? As we head towards the G7 and think about global geopolitics, we will get the lowdown next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome back to the European market open. 22 minutes past 8 here in Europe, and European equity markets fairly unchanged at the aggregate level. Now, as leaders gather this week for the G7, Joe Biden will seek support from European partners for his tough line on China. Something emerging soon, literally, is a new undersea data cable set to connect the Asian giants with Europe. The US says they won't use it. But what's the risk for European data? Danny Berger reports.
They are the internet skeleton. About 400 of them already cover the planet. And at the end of this year, the latest undersea cable will emerge off the south of France, dubbed the Peace Cable. It'll be able to transfer 90,000 hours of Netflix from China to Europe and Africa in just 1 second.
Peace is a Chinese cable. It's paid mainly by a Chinese operator. And as I have mentioned, it will use mainly to transport some Chinese data.
The cable itself will be built by China's Hongtong, and French telecom giant Orange will operate its landing station in Marseille. The French port will connect China to Europe via Egypt over 7,500 miles across the Red Sea and the Suez Canal. Another route will head to South Africa via Kenya over more than 9,000 miles across the Indian Ocean. A feat in engineering, but the biggest hurdle may be geopolitical. Huawei is a big shareholder in the company building the peace cable, a sticking point on security for the U.S.
In Canada, for example, we've seen data be rerouted to China. We've also seen, for instance, what happened with the Africa Union. So it's clear that Huawei has a pattern of behavior that shows data being moved to China.
Internet giants like Google and Facebook already said they won't use the peace cable, officially because they have enough data transfer capacity. However, last year, both Google and Facebook suspended part of another cable they were supposed to build between LA and Hong Kong over data security concerns. While the U.S. has taken a harder stance against Chinese telecom technology, French President Emmanuel Macron and German Chancellor Angela Merkel have signaled that despite the security risks, they won't isolate China.
You don't take unnecessary risks, but there are many risks associated with taking a nationalistic view to technology. It can potentially break the architecture of the internet.
And whether or not the U.S. is happy about it, the proportion of Chinese-built undersea internet infrastructure is projected to grow from 11% in 2019 to 20% in the next decade. A silent fight underwater for supremacy of the World Wide Web.
Interesting as we get towards the G7 to throw that into the mix, that particular data cable between China and Europe, China and Africa. Let's think about where we are on these markets then. We are heading towards that G7. European equity markets fairly flat, heading towards US inflation data, of course, tomorrow. But in terms of the movers, this is the picture we have for you. LVMH moves to the upside, Kering moves to the upside. Luxury stocks doing pretty well. Jefferies upgrading price targets of some of these. Momentum is strong in that sector, according to that broker. Danone is down by 1.5%. They've seen a downgrade to expectations for that particular business at RBC. We also have in here aviation. We've got Lufthansa in 1.6% to the upside. There's quite a few movements to the upside in aviation stocks. We've seen an easing of restrictions from US aviation rules, the EU approving the passport that has been now proposed and approved, as I say, in the EU Parliament. So that is of interest. But add on to that, the UK now talking about a markets authority probe. So there's a mixed dynamics, I suppose, for that particular sector to deal with this morning. But with all of that in mind, we are seeing moves to the upside, broadly speaking, for travel stocks. Coming up, we will get back to our conversation around global inflation. We'll speak to the economist who declared that inflation was dead in the 1990s, but now believes he is seeing signs of its rebirth. The chairman and founder of Capital Economics, Roger Bootle, will join us next. We'll ask what relevance parallels with the 70s have, if any. We'll also think about what is going to tell us whether inflation is entrenched and when do we get to find it out. That seems to be a crucial part of the inflation story right now. This is Bloomberg.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into Wednesday's trading session and fairly flat, actually, at the aggregate level. In terms of the individual markets, though, we do see some movement. Certainly the Paris market, the luxury stocks moving to the upside, no doubt helping there. We also see movement in Danone and Renault. You see those on the bottom of the screen. Renault, a bit of a laggard this morning. The FTSE 100, though, is more of a laggard from an overall markets perspective, down by 0.4%, as we see the rest of European equity markets fairly flat. When we dive into the GRR function then on the Bloomberg, we'll get a breakdown of what's happening sector by sector. Travel and leisure, we flagged this a moment ago. That is the biggest gaining sector actually now, up by 0.5%. A host of things going on there. US travel rules, EU passports, all of that in the mix. We also see basic resources as the biggest falling sector, down by 0.5%, which obviously has a weight in London. And so that might go some way to explain why we're seeing weakness there. Insurance also weaker, down by 0.4%. Now, inflation is a big theme of this week. We've had PPI data out of China. We look ahead to CPI tomorrow from the United States. But let's think about food inflation. The cost of raw ingredients has roared higher since the start of the pandemic. This has raised fears that a broad commodity boom could push up food prices for consumers. A United Nations gauge of world food costs has risen to the highest in almost a decade and may well continue its upward path. Food inflation fears come at a time when economies and supply chains are still struggling to overcome the COVID crisis. Joining us now on set, Bloomberg Commodities reporter Megan Durisin. Megan, very nice to have you with us. Thanks for joining us. So what has driven food prices higher there? And we've seen it for 12 months. What have been the key drivers? Often with food, it seems to be dependent on which crop you're looking at, but tell us the sort of big picture story.
Sure. So there's really a mix of supply and demand shocks going on here. Bad weather has been a factor, especially in Brazil. There's been a bad drought that's hit crops from corn to coffee. On the demand side, China's purchases of crops all around the world has just been surging. And then we're also seeing rising demand for things like biofuels, part of this greener energy push that's made prices of vegetable oils skyrocket, which is one of the factors.
So there's a host of factors, and I suppose looking ahead then, as we worry about inflation in various parts of the world, is this set to continue?
So all eyes right now are on the weather, especially in places like the US, Europe, and Russia. Wheat, corn, and soybean crops are going in the ground, and we really need bigger supplies of all of those to help replenish some of the drained stockpiles everywhere. So that's really going to be the focus going forward, as well as if China is going to continue this rapid buying pace.
Okay, lots to watch out for then. Megan, thanks very much. Our Bloomberg Commodities reporter, Megan Durisin, with a heads up on what's happening with food prices. Now, staying with the inflation theme, in 1996, 1986, my next guest wrote a book about the taming of consumer prices. Back then, he argued that decades of consistently high rates of inflation had come to an end. But now he says he sees a rebirth of price pressures and is sounding the alarm. Let's speak now then to Roger Bootle, Chairman of Capital Economics, who I'm pleased to say is with us this morning. Roger, very good to speak to you. So you say that you are now concerned about inflation. You think there's something important going on here, but you don't think that this is like going back to the 70s and 80s. Why are those parallels flawed?
Well, the 1970s, they really were a quite extraordinary period. In particular, you've got to look at the history. I mean, whenever I'm thinking about economic issues, that's what I do. I look at the history. And the fact of the matter is, you'd had quite a long period before then of persistent inflation, not very high, but persistent inflation, and it was storing up some problems. Then you had the breakdown of the fixed exchange rate system, the Bretton Woods system, and a period of chaos. And you had expansionary monetary policies. The monetary authorities really behind the curve, not paying enough attention, I think, to the inflationary danger. And then, of course, you had the oil price surge. You had two oil price surges, actually, in the 1970s, 73-4 being the first one. And that drove prices higher. I think this is a very different situation. And I don't think we're going to get inflation anything like as high as it was then. But I do believe that there is now a significant inflationary danger.
So give us some thoughts as to why you think that is then, Roger. Why do you see that inflationary danger? Because some of the things that you talked about in the past and other economists have cited as to reasons we saw a low inflation period are still there. We still have globalization of certain industries. We still have price discovery by technology, by Amazon, for example. We still have perhaps reduced wages, bargaining power for trade unions relative to certainly the 70s. So why do you think then that we are going to see a real inflation push?
Well, in some ways, this is quite amusing, at least to me, because when I wrote that book, The Death of Inflation, what I had to say was really very unorthodox indeed. In fact, lots of people, lots of central banks said I was talking nonsense because I was putting a lot of stress upon these supply side factors that you've mentioned. And in particular, the rise of China. And what I said was that I thought these factors were going to unleash a series of price cuts and intense price competition, which was going to make the old wage price spiral difficult to get going, and indeed was going to suppress it. That's what I said then. And I think, broadly speaking, that's pretty much how things panned out. But I always was aware of the power of monetary policy and the power of demand. I never put that to one side. What's happened now, it seems to me the orthodoxy has been completely overturned. Now the orthodoxy seems to be, money supply doesn't matter, stance of policy doesn't matter, you've got all these cost reductions and you've got competition. I find all this terribly funny because, you know, there's been globalization in Venezuela, Zimbabwe, Turkey, all the other countries that have had quite rapid inflation over the last several years. When it comes to it, it's the stance of monetary policy, the build-up of these big money balances in the hands of households, the stance of fiscal policy, the very low interest rates. I think this is what really makes this a particularly dangerous period.
So that's the driver then. It's the monetary and the fiscal policy that you cite there, Roger. What about climate policy? Is that something that's going to add some inflationary pressure? We've certainly heard that from a couple of voices so far.
I think that's right. And it's not that I think that the supply factors and institutional factors aren't relevant in the current setup. I think they are. You rightly pointed out a moment ago that some of the forces that held inflation back before are still very much there. They are, although I think that there's a waning. In particular, what's going on at a global level, we may not have the tariff war that people talked about before, but I think you can begin to see signs of the world having to make a choice between China and the US. I think it's going to bifurcate between two rival groups, and that is going to lead to cost increases. And I do think that the moves against climate change are going to lead to substantial increases in costs. Now, if you put all this together, although it's not on the scale of the 1970s in the slightest, I think you've got quite a worrying combination, because when people see prices going up and they're aware that interest rates are terribly low, and their expectations are not necessarily anchored, and the monetary authorities are not saying, you know, you better watch out because we're going to be raising interest rates pretty soon, then I think this comes to be quite a nasty combination.
That can be a nasty combination. And thinking about the role that we see here for oil prices, this, we've already established, going back to the 70s might not be all that helpful. But do you see a period, given climate policy, do you see a period, it's possible we get underinvestment in oil during the transition, and that has the potential to drive inflation as we transition away from oil towards other sources of energy? Is that something we need to be putting into the mix as well, Roger?
I suppose that's possible, yeah. It's not, frankly, uppermost in my mind when I'm thinking about the various dangers. Yeah, I think it's certainly a possible factor. In the background, there's something else that I think is really very important indeed, which is the influence of demographics, which is not going to, admittedly, determine what happens to inflation on a month-by-month or even a year-by-year basis. But we have, moving out now, I think, of a quite extraordinary period where there was a big surge in the labour force, driven by China, but not only about China. And now, of course, that's falling in China, and it's falling in a number of other countries as well. This is what I'm more concerned about. The oil factor you rightly draw attention to is one of those things that can lead to a spike in prices and costs, which is worrying. But I think this factor about demographics is a much more powerful and long-lasting background factor.
Let me just ask you finally then, Roger, about the role that wages play and what you see here, because some people suggest that wage is the important link in determining just how long-standing this spike in inflation is going to be, how it will embed itself. I wonder if that's what you're watching. Do you think news coverage, the conversations we're having right now, also has a role to play in inflation expectations? I mean, we've got a chart that shows just how much coverage there's been of inflation in recent days and weeks, which is quite interesting, shows a sudden spike upwards. What is it that you think turns a temporary blip into something that's more entrenched?
Well, I've always thought that with regard to inflation and indeed deflation, psychological factors play a very large role. Of course, they're very difficult to forecast or anticipate, but you put your finger on it. I think wages hold the key here. It'll be some time before we know the answer to this, but I think within a couple of years, I think it is as long as that, we'll know whether the surge in prices is just a one-off increase in the price level effectively, and is not going to lead to continuing inflation, or whether it's going to get passed through the system. And my guess is there will be a bit of that. So I expect inflation to settle at a higher level than we've seen it recently. And the wages will be the key thing I will be watching.
Roger, thanks so much for joining us. Good to speak to you. Roger Bootle, Chairman of Capital Economics. Thanks for spending time with us here on the European Market Open. Let's get a Bloomberg Business Flash. Top corporate stories this morning. Here's Juliet.
Anna, the UK is pressing for the City of London to be exempt from a plan to make multinationals pay more tax to the countries they operate in. Chancellor Rishi Sunak is expected to make the case that financial services should not be included in the deal when talks move to the G20 next month. He says he wants to make sure the right companies pay the right tax in the right places. EU leaders and President Biden will commit to ending outstanding tariff disputes when they meet in Brussels next week. Draft documents seen by Bloomberg reveal both sides will pledge to remove tariffs related to a steel and aluminium conflict by the end of the year. Also included is a plan to end a near 20-year dispute over aircraft manufacturing that saw more than $18 billion of exports subject to levies. The UK has deployed military personnel to hotspots in northern England to help combat the spread of the highly transmissible Delta variant of coronavirus, first identified in India. Health Secretary Matt Hancock announced a strengthened package of support, including more testing and door-to-door visits to encourage vaccine take-up. UK officials must soon decide whether to lift remaining lockdown restrictions on June 21. Hyundai has been reprimanded by the UK advertising watchdog. The Korean company had claimed one of its hydrogen fuel cell cars purifies the air as it goes. But the Advertising Standards Authority has found that misleading and said it mustn't be repeated. Hyundai said its claim was based on the car having an onboard air purification system. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Juliet, thanks very much. Juliet Sali in Singapore. And Jules was just mentioning there the story about how the UK is pushing for a City of London exemption when it comes to the globally agreed minimum taxation rate. That is part of the G7 conversation as we build further towards the G7 leaders meeting, which is coming this week in Cornwall in the southwest of England. And Jules was mentioning that story, so I draw your attention to a line coming through from an EU official. The EU expects all companies to pay their fair share on tax. So perhaps not smooth sailing for Rishi Sunak's plans there. We will watch that conversation at the G7 with interest. Coming up on this programme, Ken Moelis gives us his thoughts on meme stocks and warns we could see another Archegos-style collapse. We'll hear from him next. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the European Market Open. 15 minutes until the top of the hour, so 15 minutes to go until 9 o'clock here in London. So 45 minutes into our trading session. That's a roundabout way of saying that. And we've got a mixed picture for you on these European equity markets. Basic resources weighing down on the FTSE 100, luxury boosting the CAC 40 to some degree. Inditex down 0.3% despite beating estimates in its earnings. Now, veteran dealmaker Ken Moelis has likened the market for meme stocks to gambling. He's warning that a lot of people aren't making an investment decision, they're making an emotional one. He spoke at the Bloomberg Deals Summit.
I think you're in a global craps game where everybody's talking to each other and they're having a blast. And then, by the way, you get to go home, the market shuts down, and you get to go to a bar. I understand you go to half of these bars, and the meme stocks are half the conversation. So it's just a lot of it's fun. Now, at every crap table, 70–80% of the people are having fun and know they're going to lose their money and accept it. And there is somebody who's going to lose their mortgage or try to hitchhike home or lose their college fund. It's sad. I think a lot of the meme stocks are people having fun, and we don't analyze them. It's a social. It's almost what Roblox did, by the way. Not only do you have the creation of gaming online where you can talk to each other, but you have multiple creators people, Reddit and the boards, people are trying to create the next game. I understand there's a couple of new games starting this morning in the meme stock world. And so you have multiple players and you have multiple creators. I think they're having fun.
Which is so funny, too, because we know your son also started a fintech company that focuses around investing and poker as well, though that's the saving side of things. I do want to ask, though, because you were so early. In February, you told me that you were worried about leverage in the market. That was before Archegos. So what are you worried about now?
At the end of any cycle, leverage is the thing that usually takes people out. Because leverage makes you make the exact decision you don't want to make at the point, you don't want to make it. And so we run, as a company, we run a debt-free model. We run a pretty cash-heavy model. We have never had a piece of leverage on the firm from the day I started it. We've been through 2 crises, and instead of reeling from those crises, I believe the firm accelerated because our firm is prepared, the model is prepared for acceleration out of the cycle. And we're seeing that in COVID too. I mean, COVID was a disaster for people health-wise, but the business itself is in great shape and accelerating. And I believe that has to do with your whole question, Sonali, about debt. Debt is somebody else's ability to affect your business at the exact moment you want to be left alone. And that's when things surprise you. And you're not ready for it. So it'll happen again. Look, we'll cycle out of this and it'll happen again.
Ken Moelis speaking at the Bloomberg Deals Summit. Really interesting comments there on meme stocks, debt and leverage. Coming up, going gangbusters. Sterling jumps as the Bank of England's Andy Haldane strikes an optimistic tone on the UK economy. We discuss that and plenty more with Laura Cooper from the MLIV team. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open, 52 minutes into our trading session, and we're fairly flat across European equity markets in the round. Basic Resources weighing on the London market. Laura Cooper from the MLIV team, the Markets Live team, is with us. Laura, good morning. Let's focus on these comments, just because they were such fun, from Andy Haldane of the Bank of England. Of course, he's leaving the Bank of England soon, so maybe the market will listen a little less, given that background context. But he's talking about the UK economy going gangbusters, and the Bank of England might have to dial back some of the support it's providing to the UK economy. I mean, how out of step is he? He's always been pretty hawkish, or at least recently has been. How out of step is he with what others are saying?
Well, I think market watchers like myself will certainly miss Andy Haldane when he leaves at the end of the month, because he is known for just these kind of outlandish or statements. So we had him say the economy was running gangbusters. He has attributed consumers to crouching tigers waiting to pounce. But that is actually what we are seeing in the data. Now that lockdowns are being lifted, the UK economy is quite robust. But the comments this morning, I think what's more surprising is the fact that we are seeing sterling on the front foot, because really he hasn't changed his stance from what we've seen from him over the past couple of months. And really at this point, other MPC members are more cautious. We don't know how those furlough schemes will unwind. There's a lot of uncertainty ahead, but certainly some fun to add to our morning this morning.
Yeah, some fun to add. We did see that the pop in the pound, as you see on the screen there, on his comments, as the algos tries to get to grips with some of the British vernacular he was using elsewhere, perhaps, and the sporting analogies. But then we've seen some of that kind of come down, haven't we? In terms of the inflation story then, Laura, we're focused in Asia and also in the US this week. We had the China PPI number coming through, and that was really strong, wasn't it? The highest since 2008. But that was widely anticipated, I suppose. Any sense that that's causing a rethink on US CPI, people's expectations going any higher there?
I don't. That certainly doesn't appear to be the case. Yes, we did have those producer prices in China pop higher at 9% year on year to those 2008 highs. That's not yet feeding into consumer prices, but it's quite a different backdrop in the U.S. And I would say that even though we are seeing signs of labor shortages, we are seeing potential upside risks to wage pressures that can feed into that inflation. When we look at what's happening in the Treasury market, 10-year Treasuries have been relatively range-bound since early April. And in fact, they're trading at the bottom of that range now, despite what we've seen in terms of those potential signals of inflation. So that does suggest that markets are pinning to that Fed conviction that price pressures are likely to be transitory. So I think key will be that CPI print tomorrow, and whether we do see another upside surprise, and whether markets at that point recalibrate those expectations.
Yeah, it's interesting to think about, and I know that you have been on the Markets Live blog, the extent to which inflation risks are priced in. Because when you look at a US 10-year yield at 1.51%, amidst all of this talk about whether the taper conversation will happen soon, it's lower than it was in April, where we had a 1.7 handle or so, Laura. And you wonder, you look at that kind of level of US yield and wonder whether inflation spikes are priced in.
Yeah, and I think that is what rates markets are telling us, is that they do expect that this is going to be just temporary bouts of price pressures, that ultimately these supply constraints will be alleviated. We will see workers return to the workforce. That will alleviate some of these labor shortages. But I think at this point, it's all about inflation expectations. Those still remain anchored. It's likely going to take a series of upside surprises on those inflation prints to really signal that we are in this potential regime inflation shift. And yes, we could see a knee-jerk reaction tomorrow in terms of a spike in real yields or the dollar if we do see another upside beat. But I think at this point, markets are not going to get any clarity on that inflation debate for some time to come. So we could see yields just resume that range-bound trading for a while.
Laura, thanks very much. Laura Cooper, Bloomberg Markets Live macro strategist. Thanks very much for spending time with us here on the European Market Open. European equity market performance then this morning, fairly lackluster, fairly flat, actually just taking a slight leg to the downside, down 0.1% now on the Stoxx 600. Casting my eye over US futures, we're really very flat there. There's a lot of news to come this week still. We've got the US CPI print coming. We've got the G7 meeting taking place in Cornwall in the southwest of England. That's coming later in the week. A lot of geopolitics to talk about before this week is over. This is Bloomberg.
in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Okay, traders, as you can see, we need to place stop on profit for euro. We put 2 pips up, okay? And it's 121.796, and plus 2 pips, it will go to 121.816, yeah? Just right here. Whatever happened, all of you guys who decided to trade, stay with me and trade euro, you will close this trade in profit, okay? So as you can see, it's moving up. As soon as it will move further up, we will increase profit. In our case, we have 200 pounds already in profit because 2 pips give us 200 pounds. In your case, you had to decide. It's all about money management. You probably heard these things with many traders, but not many people really understand what it's all about. Somebody trying to hire therapists or something. It's all about, you need to figure out how much you want to invest in stocks, shares, or indices, or contracts. This is what it's all about, because you shouldn't invest 100% of your investment account, okay? So we invest amount equals 1 pip equals to 100 pounds. So 2 pips equals 200 pounds. In your case, how much you decided to invest. All this information available, how to calculate, how to figure out how much to invest in our trading strategy that you can get it from companyi.co.uk. Okay, so let's see if it will close below these 121.816. We will collect 200 pounds in profit. Let's see, and I'll let you know, I'll tell you right now what's going to happen next. Okay, looks like we're still waiting. So probably stay
I think
just
you're in a global
stay with me.
where everybody's talking to each other and they're having a blast.
Not don't try to close the trade because it's still in. Okay, I'll speak to you later, guys. We will see what's going to happen right now. As you can see, euro moving rapidly up and down.
70-80% of the people are having fun and know they're going to lose their money and accept it. And there is somebody who's going to lose their mortgage or try to hitchhike home or lose their college fund. It's sad. I think a lot of the meme stocks are people having fun.
Now, in the struggle for legitimacy, Bitcoin may well be set to lose out again amid regulatory fears in the U.S. and China. Some analysts are now predicting that the price could slump to $20,000. Well, joining me is the ever student of Bitcoin, but also, of course, of markets, and he makes us smarter on what's ahead. MLive's Eddie van der Walt now joins me. Eddie, thank you so much, as always. Also, an Eddie in the office, which is quite exciting for the newsroom. When you look at Bitcoin, so, you know, we could talk about Death Cross, but you have a number of basically broker companies saying that it will go to 20,000. Are we looking at technicals, or are we just looking on, you know, popularity on Reddit and other places?
Well, I can definitely say, being in the office is a little bit louder. I've had a number of people complain about, you know, my volume on the telephone. But listen, Francine, I think you're right. I think there's a lot of nervousness about Bitcoin, because in the previous cycles, what we've seen up to we've seen up to an 80% drawdown in Bitcoin in the peak in 2017. We've seen the similar in the prior manias of Bitcoin. We've seen pullbacks of that scale, and we haven't had a pullback of that scale just yet. We've had a pullback of about 50% or so from the high, or somewhat less than that. So there are a lot of people who are worried that we get a similar size drawdown here, and it feels like the regulatory mood has just changed. People are a bit more nervous about the Fed and the powers that be in China just pushing back against Bitcoin.
But so I want to bring you to our morning must-read, actually, Eddie, and this is a Bloomberg opinion columnist, John Authers. We both know him, writing this morning that Bitcoin has run into moments of speculative excess that certainly look like bubbles several times already, but he argues, as I've pointed out before, the price has gone on to recover. The analogy of a fad or a virus that finds a way to mutate is a better one than a bubble. I mean, what does that mean for traders?
Oh gosh, that is a good line. That's the problem with John Authers. He's so good at what he does. It's almost irritating. I tell you what. I mean, I read that and I agree. And the situation with Bitcoin is such that, you know, if you play it on the short term, then timing is absolutely everything. Picking it wrong, can be catastrophic. I know of people that bought in 2017 and, pulled out in sort of 2019 and lost pretty much everything that they put in. But on the other hand, if you look at this as a long-term technology play, then Bitcoin's been absolutely fantastic, right? People have made absolute billions on it. So it's all about your time frame and your risk appetite as an investor. Are you willing to lose, 80% in the short run to make the long-term gains? And that is what you've got to look at with Bitcoin.
Eddie, what else are you looking at in the markets? I mean, I know that the question that comes, in and out every couple of days is, are we going to be importing inflation from China? And how problematic that is going to be.
Yeah, we had a lot of noise from China pushing back against higher commodities prices, but it is, China is, of course, is a price taker in many commodities and is the buyer in many commodities, so that they want to see lower prices is not surprising. I think, there's cost pressure everywhere. We are seeing small businesses struggling to fill vacancies. And I think that is more worrying for people like the Fed and for the ECB. Of course, the ECB will be quite happy. Going into the ECB tomorrow, I think that is the big event for now. And, some data out of the US as well. But I think for the ECB, they would love to see just a little bit of inflation coming through so that they can start raising rates, so that they can see their banks on a better footing.
Yeah, but equities, I mean, they're still on a tear.
They are, and I think even if we see if we see a pickup in inflation and we see higher rates, that's going to hurt the tech stocks. But I think we're starting to see a market that is strong enough that it can perhaps sustain a bit of a rebalancing and a pivot away from the tech stocks, and maybe into value and so on, and that the overall indexes won't be hurt too much.
Eddie, thanks so much. Eddie van der Walt there from our MLive team, joining us on some of the market moves, including Bitcoin. Now, Smart Conversations on Bloomberg Surveillance Early Edition. Stay tuned for our exclusive guests this hour. Later on in the program, we'll preview the upcoming ECB meeting with the former president, Jean-Claude Trichet. Up next, though, we speak to former European Commission president and current co-chair of the Reform for Resilience Commission. He's José Manuel Barroso. If you have any question for our guest, just IB plus TV Go. This is Bloomberg. financial sector has made some progress with minority and female inclusion, but any momentum has slowed in the wake of COVID-19. I'm Francine Lacqua, and we'll take a look at the pandemic's unequal impact on financial services. We'll delve into the data and some of the reasons behind the drastic drop of women in the workforce. We'll also get the views of two very senior women in the industry on creating an inclusive environment, retaining talent, and the future of work. All in our latest Money and Equality special this weekend on Bloomberg Television. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, our next exclusive guest is a former European Commission president and current chair of London-based Goldman Sachs International, José Manuel Barroso. This morning, he joins us as a current co-chair of the Reform for Resilience Commission, which groups leading figures in business, science, and politics, pushing for a truly integrated approach to global health, economics, and the environment. Much like a post-pandemic Bretton Woods, well, José Barroso joins us now. Welcome to Bloomberg, and thank you so much for giving us a little bit of your busy schedule. First of all, Mr. Barroso, when you look at everything that's going on, the recovery, but also the need for vaccines, vaccine distribution, not only in developed countries, what are we getting right, and what are we getting wrong?
First of all, I think we have to learn the lessons of this pandemic. It's true that there was great progress in vaccines, record, so we could develop vaccines in a record time, but there are problems in terms of distribution and delivery, and there are inequalities also. And one point we have been saying is that we need a stronger commitment to rapid vaccine delivery all over the world, because it's not just a slogan. It's no one is safe until everyone is safe. Why we say that? Because while the virus is circulating, there are more possibilities of new variants, possibly more transmissible and more dangerous, and we are seeing that, in fact. So at the same time that there has been very successful rollout in some parts of the world, namely in UK, in the United States, also Europe now is catching up, and other parts of the world, the reality is that there are other, let's say, low-income countries that are much behind. So we need to speed up that effort. But besides that, besides this most immediate priority, because the pandemic is not over, far from that, we need to think globally about what we are going to do in the future. And what we are proposing, this Resilience Commission, is that we look at the issue of health and economic resilience as seriously as we have been looking after the financial crisis of 2008 and the following years to financial sustainability and stability, and also as we are looking to climate change. And in fact, those issues are linked. So health, economics, and environment are linked. And what we are proposing, based in a study of a very, let's say, great scientists from a great network all over the world, is for the G7 and then the G20 to take the leadershipness and to make this a kind of a Bretton Woods moment where we can look holistically in a much more determined and structured way to the issues of health resilience.
But Mr. Barroso, do you see that countries and leaders are willing to do so? Are we at a moment where actually there's a lot of commonplace for leaders to come together, or is it still each for their own? I mean, we're seeing even with taxes now, the UK wants financial services to be exempt from this 50% global tax. What does that mean in practice?
Look, in general terms, I see some progress. Like this last week, I had the honor, together with the Prime Minister of Japan, to host a pledging conference for COVAX, for the global facility to distribute vaccines. And in fact, we exceeded our objectives. So we have seen also great cases of generosity. But more has to be done in terms of commitment. For instance, in terms of dose sharing. Countries that have surplus doses, we have to share some of those doses. If not, of course, we'll have huge differences that can only become more serious. So we see some progress, and we believe that the leaders of G7, the wealthiest countries in the world, now have to do more. We hope, in fact, to have some progress in this G7 summit. We saw also some announcements made, not only in terms of financial commitments, but also in terms of solidarity to the developing world, to low-income countries. And we believe this is a way forward. And also, by the way, the OECD should be part of it through also some of these measures that we are proposing. So yes, there is some progress, but to be honest, Francine, not so much as we'd like to see. We need more urgency.
In what kind of field? So specifically, what do we need to work on? We keep on hearing from leaders that they're rebuilding better, but actually, what is the actionable thing that they can do in the next 2 months to make a real difference?
First of all, I mean, increase the pace of vaccination. And I've told you how we can do it by sharing doses globally. Of course, the pharmaceutical companies, they are ramping up production to have more funds for those who don't have the means to buy those vaccines. This is a very concrete thing. I mean, to go as far as possible. We believe now it will be possible by the end of the year, beginning of next year, to have at least 1.8 billion of vaccines distributed to low-income countries. That's what we are doing. And that has been progress. This is the first thing. But beyond that, we have to recognize one thing. The world was not prepared for this pandemic, including the richest and the most powerful countries in the world. They were not prepared. There were not mechanisms of adequate surveillance, sharing of data. There was not, in fact, even some protocols of cooperation. So we need to invest more. There was the investment on health resilience was neglected for many years. And what we are saying is that we should consider this matter of health resilience at least as important as financial stability or climate change. And these matters are connected. That's why we are proposing the leaders to have a kind of a Bretton Woods moment to reinforce the global mechanisms, for instance, with increased transparency in terms of pandemic preparedness, but also further investment in global health, because health is very much linked, of course, as we are seeing, to economics.
Mr. Barroso, so going back to what Rishi Sunak seems to want to propose, which is that financial services and finance companies be exempt from this 15% global tax. Do you agree with that? Is that the good strategy for banks based in London?
I'm sorry, I have not yet seen that proposal. I'm not in a position to comment. I believe the global effort to have a minimum tax that is being promoted now makes sense. And I think there is progress made by the G7 at the level of finance ministers, and most likely we'll see that now ratified by the heads of state and heads of government meeting this weekend in UK. That is progress, and the OECD is working on that, and we hope that the G20 will approve that as well. Now, about that specific proposal, I'm so sorry, but I have not yet seen it. I cannot comment on that.
No, it is absolutely fresh and new, so of course I respect that. So, Mr. Barroso, when you look at some of the tensions between the UK and the EU because of Brexit, again, what's the right way forward? What does it mean for financial services? Do we just need some kind of agreement on the protocol that the EU need to back down to make sure that actually we're on a much steadier path and more of a friendship between the two?
There has been some friction, unfortunately. I believe it's unfortunate to have this friction, but in a way it was almost unavoidable. I mean, when there is a separation after so many years, it's like in a couple, there is some trauma. And we are still in this post-traumatic moment in the relations between the UK and the European Union. I hope now there will be more constructive talks. There are issues that have to be addressed. The issue of Northern Ireland is a very complex issue. But I believe in financial services. If you want my sincere opinion, I'm not speaking completely independent. I'm no longer president of the European Commission. I remain a very committed European. I believe that there will be divergence. I think now it's quite clear that the United Kingdom wants to go its own way. It has its right to take also some, let's say, benefits from some, let's say, specificity of its financial regulation, which does not mean, by the way, I don't think it means that they are going to lower the standards. I know well the British regulators, they are extremely strict. They are not going to lower the standards, but in fact, they are deciding to go their own way. And also the European Union that accepted the free trade agreement in terms of no tariffs, no quotas for goods, has not completed a financial services agreement with the United Kingdom and will not complete. There will probably be a memorandum of understanding with some global principles, yes, but I do not believe there will be some kind of passporting or the rule of equivalence. So we are going to see some divergence in terms of the global approach to financial services in Europe, in the Euro area, but also in the European Union as a whole and in the United Kingdom.
So how do you see London actually faring as a financial center given all of this?
London is one of the two biggest financial places in the world, and I believe it will continue to be because it has a great tradition, great know-how. It's a hub. It's, a cluster not only of very important financial institutions, but legal, audit companies. I mean, there is a real, let's say, cluster of strengths here in London. At the same time, we are seeing also that the European regulators are making it clear that they want that those who are operating, namely in the euro area, and the European regulators, everybody around the European Central Bank and European Central Bank, making clear that they want also those capabilities to go to Europe. So in Europe, there will not be just one center. It's from Paris to Frankfurt to Milan to Amsterdam to other places. So there will be, I think the international banks are going to increase their footprint in Europe. But London will certainly remain a very important and global major hub for financial services.
Thank you so much for your time today, Mr. José Manuel Barroso there, the former European Commission President, co-chair of the Reform for Resilience Commission, and of course, chairman at Goldman Sachs International. Now, smart conversations continue on Bloomberg Surveillance. Early edition coming up, we'll speak exclusively to the former ECB President, Jean-Claude Trichet, about the upcoming central bank meeting. Now, if you have any questions for him, IB plus.
Okay, guys, let's move further our stop on profit for euro. We'll move to 121.84.6. It will give us 5 pips. In your case, it will give you 5 pips too. The point I'm trying to make, it will increase our profit. Okay, guys, so we're already in profit. Let's see what's happened with other pairs. We're still short on Japanese yen, as you can see from our ticker. So we're still waiting. Maybe I will purchase another. We'll get another contract for Japanese yen, but we will see. We'll see. I'll speak to you later.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The UK is pressing for the City of London to be exempt from a plan to make multinationals pay more tax to the countries they operate in. Chancellor Rishi Sunak is expected to make the case that financial services should not be included in the deal when talks move to the G20 next month. He says he wants to make sure the right companies pay the right tax in the right places. Now, EU leaders and President Joe Biden will commit to ending outstanding tariff disputes when they meet in Brussels next week. Draft documents seen by Bloomberg reveal both sides will pledge to remove tariffs related to a steel and aluminium conflict by the end of the year. Also included is a plan to end a near 20-year dispute over aircraft manufacturing that saw more than $18 billion of exports subject to levies. The US and EU are set to back a renewed investigation into the origins of COVID-19. In a draft statement seen by Bloomberg, they are to call for a transparent, evidence-based WHO study that is free from interference. Several countries have called on China to be more transparent amid ongoing questions over whether the outbreak was caused by a lab accident transmitted from wildlife or something else. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, coming up, European stocks near record highs as the EU finally hits its 2% inflation target. What should the ECB do next? Well, we'll discuss inflation with Jean-Claude Trichet. If you have any questions for him, IB plus TV Go. This is Bloomberg.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley. It's a management shake-up, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
A capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Well, Bitcoin's pain continues. A digital currency fluctuates with strategists from Oanda, Evercore, and Tallbacken eyeing a drop to $20,000. The UK pushes for a City of London exemption from the global tax deal set in motion just days ago. Rishi Sunak will make his case at the G20 next month. And up next, the former ECB president, Jean-Claude Trichet, joins us to talk about the central bank's upcoming meeting, or more than that, also inflation. Well, good morning and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, it may have taken a global pandemic and unprecedented stimulus measures, but the ECB has finally hit its 2% inflation target. European stocks have ridden the wave to a 5-month winning streak, the best in 8 years. But what should the ECB do next? Now, if Europe's central bank wants to align with the Federal Reserve, which has a much higher CPI figure to contend with, then the answer may be nothing at all. Our Bloomberg opinion columnist Marcus Ashworth writes, a brief period above its target is the least of Europe's troubles. The smart thing for Frankfurt's monetary policymakers is to head for the sun loungers and not meddle with the course they've set. Well, joining us now, Jean-Claude Trichet, the former ECB president. Monsieur Trichet, thank you so much for joining us. I know you're also doing a lot of work, of course, on sustainability, climate change, and actually how you make this recovery stronger. First of all, given what we know so far, are you confident that leaders and central banks will rebuild a stronger economy? Are we rebuilding back better?
I think that, of course, it is the very important question. And there is at least a consensus to consider that we have to draw all the lessons from what has happened and prepare very, very actively for all what is transitioning, namely the digital transition, the climate change, and I have to say a number of other lessons that we can draw from the COVID-19, including, of course, the health issue, which is so important as a global goods, a global public goods. So clearly, we are in a different universe from now on. I take it that as far as there is a consensus by, I would say, all countries concerned, particularly since the change of the administration in the US, including in the US, that is, inciting to some optimism. But the task is very heavy, and there is no time. This is no time for complacency at all, of course.
Mr. Trichet, when you look at some of the inflation debate, first of all, are you worried that Europe will simply be left behind because we don't have the amount of stimulus that the Biden administration is throwing at the US?
Okay, guys, position closed on euro at 121.84.6. Okay, we have 500 pounds in profit. If you want to get the strategy, you have to go to companyi.co.uk. Let's move on. Let's see what other pairs will give us a profit, and let's see what the indicators and strategy will show us on other pairs. Okay, I'll speak to you later, guys.
Get back to a more normal level of price stability, namely around 2%. And that was the case in Japan, in the US, and in Europe. If we see that we are closer to anchor inflation expectations around 2% in the medium and long run, it's good, of course. We could not continue forever with a very low level of inflation below the definition of price stability in most European countries, and in all European countries, by the way, and in most advanced economies. So I think that all taken into account, it's good that we see that we are getting out of the 0-1 level, which is not yet the case in Europe, as you know, because we have an HICP at the level of 2%, if I understand well, but it is due mainly to the energy prices that are plus 13%. And if I take the core inflation in Europe, we are still at the level of 0.9%. So clearly, we have a phenomenon which is very much linked to energy prices in Europe.
I know you've always been very cautious about, sounding like you're giving the current ECB president advice, and you've never really done that in the past. But if you're still in charge, there's a number of things that, of course, President Lagarde is looking at. Should it be just steady as they go? Is this not the right time to do anything for them?
Well, we will see exactly. And as you know, we will have tomorrow the new projections of the ECB and of the Governing Council, and those projections are very important, both in terms of growth, in terms of inflation. So we will see. I don't want to, I would say, anticipate on what will be said tomorrow. I would not be surprised, obviously, if there was a reviewing up growth, because clearly we are at a moment in the global economy and in all economies where things are going better, at least in the advanced economy, very, very visibly, because of the health issue, the vaccines that are going now very, very well, including in Europe. And so it would be normal, in my opinion, to observe some kind of pickup in the projection. But we will see. And I don't want to anticipate, as I said, in any respect. But all that being said, I'm sorry, please.
No, go ahead.
No, all that being said, it looks like, again, in terms of anchoring solidly medium and long-term inflation expectations around 2%, and we will see exactly what will be the conclusion of the policy review that is ongoing. But it seems to me that we are certainly not at a level where inflation would be a danger in Europe. In the US, it's different.
Do you think that there is a danger that actually the US economy overheats to a point where, the Fed will have to do something when the market doesn't expect it?
Yes, it seems to me, again, the US is in a very different position in comparison with Europe. That's absolutely clear. We have a level of public finance deficit which is extremely high. According to the IMF, something like 16% in year 20. In 21, minus 15% of the GDP. So it's big, it's very big. And we have a current account deficit, which is the structural current account deficit of the US, but which is at the level for the forecast of the IMF, minus 4% of the GDP. In comparison with Europe, we are in Europe in a totally different universe, where the current account is in surplus in Europe, and in 21, perhaps plus 3% of the GDP. So you see, the comparison between the US and Europe is underlying many differences, and it's clear that the US is close to some kind of overheating, in my understanding. That being said, I have full confidence in the Federal Reserve to do what would be necessary to avoid inflation phenomenon that would be very dangerous. So I have no doubt that they will do what is necessary in order, again, because it's the definition of price stability on both sides of the Atlantic, to anchor solidly inflation expectations in line with the 2% figure.
Jean-Claude Trichet, thank you so much. The former ECB president stays with us, and we'll talk a lot more about the G7 and taxes, because coming up, as G7 heads prepare to meet in Cornwall this Friday, a global minimum corporation tax is closer than ever. But should London's banks be exempt? We'll have the details next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
World leaders meet. On the agenda, global tax, security, climate change. Tune in for extensive coverage from the G7 summit in Cornwall, England, and the NATO summit in Brussels. Live on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, there's quite a lot going on. We look at the meme stocks or the meme stonks, whatever you want to say, but actually GameStop, definitely front of mind. AMC also definitely front of mind. I mean, AMC, I've never seen anything like it in terms of market fluctuation. Actually, I have seen something like it. It was called GameStop. But GameStop today, pre-market, gaining 3.3%, AMC down 4.8%. Now, a 15% global minimum corporate tax is closer than ever as world leaders thresh out the plan originally proposed by the U.S. Last weekend, finance ministers from the G7 agreed to the scheme, partly intended to target tech giants and slated to include Amazon, despite its small margins. Now, as G7 heads prepare to meet in Cornwall this Friday, British Chancellor Rishi Sunak will argue for the City of London to be exempt from any new rules. Well, we're back with Jean-Claude Trichet, former ECB president. Monsieur Trichet, thank you so much, first of all, for sticking with us. And then, so we're quite excited, or some people are excited, that there was at least consensus, which is more than we've had in the last 10 years, about this 15% threshold. The UK is now trying to negotiate something for financial services. What does that mean? That we won't really get an agreement, or that we're just going to see country after country try to negotiate something better for what suits their country?
Well, we will see exactly what happens, and I consider this accord, the consensus of the G7, as an extremely important one, obviously, and certainly something that the European in particular had considered since a long period of time as very important to take up with the tech giants, as you said. We will see what happens from now on, but an accord of this type is interesting if it is really generalized for all and global, I have to say. This is an accord between the G7. It has to be put at the level of the international community as a whole if we want it to work, really. Otherwise, there would be some kind of, I would say, evasion from the rule. But again, I take it as a common sense remark that it would be good to have it apply to all jurisdiction and all sectors. That's the idea.
Because otherwise, Mr. Trichet, the idea is that if you make exceptions and it's not, then we don't get anywhere? Or what's your thinking on that?
No, I mean, again, there will be negotiation, obviously, and between the 7 also and the other countries of the world. And we are not alone. The G20 exists and the international community as a whole exists. But I would say it's a very good consensus, a very good proposal made by the G7. I hope very much that it will crystallize. And if we want it to really work, it seems to me that it has to apply to all jurisdictions and all sectors. Yes.
Monsieur Trichet, I mean, we're also all experts now in the Northern Ireland Protocol. Is it time for the two parties to actually, apologies, to put their differences aside?
Well, I think, again, it has to be solved, clearly. And I hope very much that it will be solved as soon as possible. It is certainly very, very important for the relationship between the European Union and the UK. And I take it that we must find a solution. But that being said, the negotiators are there, and we will see what they do, of course.
You look at Bitcoin.
Yeah.
Well, do you look at Bitcoin?
I have always referred to the definition of money, of currency, by Aristotle. Aristotle said very clearly a currency, a good currency, has to be a good instrument of exchange, a good instrument of accounting, and a good instrument to keep its value, and to keep its value over time. The cryptocurrencies are not good instruments to keep their value over time. They are very much speculative instruments, at least until now. Those who are not envisaging to anchor their own value. So the Bitcoin is exactly what I thought from the very beginning, a very, very speculative instrument, going up and down, up and down, up and down, and this is not a currency, of course.
Do you think that we'll see something else, a cryptocurrency that will become either a store of value or something to play a really prominent role?
Again, if we want any currency to be a good currency, accepted as a currency, it has to keep its value. I trust the central banks, the present central banks, to be very, very active in keeping the value of the currencies they are issuing. And if any cryptocurrency is directly connected to a central bank, which is the case for the central bank cryptocurrencies that are envisaged now practically all over the world, or if it is a currency which is aiming at anchoring its value to a basket of currency, then we are in a different universe. I don't suggest that I would call for this or that. I trust that it is absolutely normal that all central banks in the world are working actively to see which kind of benefit they can draw from the new technological surge. And I know that it is done everywhere, including in Europe, as is the case presently. But again, we are in a totally different universe when we are speaking of currencies that are not aiming at keeping their own value, which is the case of the Bitcoin and others, such cryptocurrencies.
Mr. Trichet, thank you so much, as always. Jean-Claude Trichet, there, the former ECB president, with us. Now, joining us a little bit later, we'll also talk about the narrative around Bitcoin and Ethereum. We'll have a couple of big shot investors. Coming up, the G7 leaders arrive in southwest England later today after finance ministers agree on a substantial global tax reform deal. What should we expect from the summit in Cornwall? That's coming up next, and this is Boom Time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
They are the internet skeleton. About 400 of them already cover the planet. And at the end of this year, the latest undersea cable will emerge off the south of France, dubbed the Peace Cable. It'll be able to transfer 90,000 hours of Netflix from China to Europe and Africa in just 1 second.
Peace is a Chinese cable. It's paid mainly by a Chinese operator. And as I have mentioned, it will use mainly to transport some Chinese data.
The cable itself will be built by China's Hongtong, and French telecom giant Orange will operate its landing station in Marseille. The French port will connect China to Europe via Egypt over 7,500 miles across the Red Sea and the Suez Canal. Another route will head to South Africa via Kenya over more than 9,000 miles across the Indian Ocean. A feat in engineering, but the biggest hurdle may be geopolitical. Huawei is a big shareholder in the company building the Peace Cable, a sticking point on security for the U.S.
In Canada, for example, we've seen data be rerouted to China. We've also seen, for instance, what happened with the Africa Union. So it's clear that Huawei has a pattern of behavior that shows data being moved to China.
Internet giants like Google and Facebook already said they won't use the Peace Cable, officially because they have enough data transfer capacity. However, last year, both Google and Facebook suspended part of another cable they were supposed to build between LA and Hong Kong over data security concerns. While the U.S. has taken a harder stance against Chinese telecom technology, French President Emmanuel Macron and German Chancellor Angela Merkel have signaled that despite the security risks, they won't isolate China.
You don't take unnecessary risks, but there are many risks associated with taking a nationalistic view to technology. It can potentially break the architecture of the internet.
And whether or not the U.S. is happy about it, the proportion of Chinese-built undersea internet infrastructure is projected to grow from 11% in 2019 to 20% in the next decade. A silent fight underwater for supremacy of the World Wide Web.
Well, that was Danny Berger reporting there on the geopolitical hurdles that the so-called Peace Cable is facing. Now let's get straight to your Bloomberg Business Flash. And actually, Saudi Aramco has started marketing its first dollar-denominated bonds. We'll have plenty more on that, of course, throughout the day once we actually get to Leanne Gerrans. Let's check the markets because they've been open for a bit, and actually it's always a good and wonderful idea to look at what trades we're seeing. The dollar slipping, the longer-dated Treasury yields lower as investors awaiting Thursday's U.S. inflation report before gauging the direction of monetary policy. Now, the other thing that, of course, we're watching for is the global markets indecision. This is a tug-of-war between traders who believe that accelerating inflation is transitory and those who bet it'll prove persistent enough to actually warrant tapering from the Federal Reserve stimulus. Now, with stocks near record levels, U.S. yields already high relative to peers, for example, traders find little room for maneuver. Then there's some of the stocks or some of the meme stocks, if you want to call them that. Pre-market, you can see a GameStop gaining some 1.1%, AMC actually down some 7.7%. Now, a couple of the other stories we're watching, of course, later today, we have the UK and EU officials meeting. The UK also pushing for finance exemption for this global tax deal. Now, Bloomberg Surveillance early edition continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lyons will join me out of New York. We'll have you covered for the markets. Of course, we look ahead to what else is happening today. A lot of conversations about the infrastructure deal in the U.S. And going back to the G7, we're expecting the UK and the EU to meet to try and find maybe some kind of agreement on Brexit. Otherwise, it risks overshadowing the G7. And then the Chancellor, of course, Rishi Sunak, also wanting to make sure that the right companies pay the right amount of tax in the right places. This is what the Treasury said yesterday, so we'll have a full roundup of the global tax deal. Again, an EU official actually pushing back on the tax deal, saying that, look, the idea of an exemption for financial services firm is not something that they're keen on at the moment. This is Bloomberg.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're debating now actively something I'm pretty excited about, a lot of us are pretty excited about, which is turning the incubator to focus very, very heavily on crypto.
We were on this path for over a year, but ultimately decided it was time that crypto had emerged as an asset class that was broadly ready for the public markets and wanted to take that step forward.
I think you're in a global craps game where everybody's talking to each other and they're having a blast. I think a lot of the meme stocks are people having fun. This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning, everyone from London, Berlin, and New York on this Wednesday, June the 9th. Our top stories today. Crypto crash. Bitcoin keeps falling. Some analysts say the next stop for the world's biggest digital currency could be $20,000. Joe Biden prepares for his overseas debut. The president flies off to Europe, where he'll meet with G7 leaders and later Vladimir Putin. And a compromise in the works while House Democrats and Republicans come up with their own version of an infrastructure package after President Biden's attempts to cut a deal go nowhere. Now, there is quite a lot going on also because we're looking at inflation prices, Kaylee, and that old chestnut of are we exporting or are we importing inflation from China has come back with factory gauge prices. What else are you seeing on the markets?
Well, of course, we've gotten that inflation data from China, Francine. We're awaiting the inflation data here in the U.S. with the CPI print tomorrow. Where that left us in the Asian session was a bit mixed. You did have Hong Kong, Japanese stocks lower. China, though, did manage to end fractionally in positive territory, but it was a very volatile session after that inflation print. You had producer prices up 9%, the highest since 2008 because of higher commodity prices, but consumer prices actually, CPI jumped less than expected, just 1.3%. That was the biggest gap between the two since 1993. After that data, we didn't see a lot of action in the Chinese bond market. The 10-year yield effectively unchanged, right around 3.13%. The Chinese yuan, though, is stronger against the U.S. dollar, as is the Japanese yen, though just fractionally, the yen sitting at 109.48. As for what the picture looks like here in the U.S., we are just shy of record highs for U.S. equity benchmarks. Right now, though, not a lot of movement in the futures market. We're up about 4 points or so on S&P E-minis. More movement in the Treasury market with yields coming in for a second day. We're down about 2 basis points on the 10-year, 1.51%. That is the lowest in about 3 months. In the commodity complex, you are seeing WTI crude holding above $70 a barrel. Bitcoin, though, below 34, or actually right now just fractionally above $34,000. But of course, that volatility has continued, Matt, and some saying it could go down to 20,000.
I feel like we're getting a little ahead of ourselves with 20, right? We haven't hit 30 yet. We're jumping. I guess Bitcoin tends to move quickly, but man, at 34,000, already looking at 20, that is bearish. Let's take a look at what's going on in European markets. We have, if you look at the world map, a lot of gray on the screen. So very little direction. Remember, we've got a really important set of data coming out. You have US CPI a little bit later. Then you've got the ECB tomorrow. So we'll see if Christine Lagarde can get even more dovish. But right now, it looks like traders are sitting on their hands for the most part. You can see that Great Britain and Ireland are both down a little bit. The Stocks Europe 600 is basically unchanged here. The 10-year bond, interesting, as you know, last time the ECB met, we were looking at rates that were pushing up back towards zero. Now they're coming down under negative 20 basis points right now at negative 23, negative 24. Euro Swissy, I'm told by the MLive blog, is a great pair to watch today because if that inflation data beats expectations, if it's an upside surprise, which I guess that's beating expectations, although maybe it's worse for the average Joe trying to buy a six-pack in America, that could push Euro higher against Swissy, and it has been coming down. Ferrari doing very little right now, and that in itself, I think, tells a story because Ferrari tapped a new CEO, a little-known tech executive from ST Microelectronics, Benedetto Vigna. Am I saying that right, Francine? Benedetto Vigna.
100%.
Is that
A+, full marks.
Okay, excellent. Well, look, it just goes to show the direction that these car makers want to head. Ferrari ahead of the pack, hiring the techiest of all CEOs. The guy comes from a chip maker. He designs things like screens. And in a Ferrari, I want to hear a V12 engine, not look at an 8-inch touchscreen, but I guess I'm not the average consumer.
Right, and that's a given. I mean, the engine sound hopefully will always be there. I love Euro Swissy. I think Tom Keane always has that tattooed to his brain because that's what the pros look at. Now, this is what else we're looking at today. UK and EU officials are set to meet today to settle a trade dispute that could spill over into G7 meetings at 10 a.m. New York time. Also, the Bank of Canada will announce its latest rates decision. We'll get U.S. wholesale inventories at that time as well. And then half an hour later, the EIA releases its crude oil inventory report. On to other big news, and a group of House Democrats and Republicans have agreed to their own version of an infrastructure package. That's after talks between President Biden and Republican Senator Shelley Moore Capito fell through without a deal. Let's get straight to Jack Fitzpatrick, Bloomberg government reporter, with the latest. So, Jack, the deal didn't go through, but now they're going to work on getting part of the deal through without the GOP support.
Well, here's where things stand. Things did not go well between President Biden and Senator Shelley Moore Capito as the point person. Biden told Capito he would cut those talks off yesterday. There is a bipartisan group of senators working together, though, so that's Plan B. They do not have a plan put together just yet, but they are working on one in a smaller group of about a half a dozen senators, and then they'll present it to a bigger group of bipartisan members, and they'll see if they can get something better than what was yielded from the Biden-Capito talks. Meanwhile, there are a number of Democrats who want to go it alone, and we heard from Senator Bernie Sanders, who is the budget chairman, saying they should work very soon on the initial parameters to push this through in a partisan way if necessary. So that would be the other backup plan. But there are still some bipartisan talks going among a group of senators right now.
You know, I'm getting numb to these numbers, I think, because 250 doesn't even raise my eyebrows here anymore. It's not even $1 trillion. It's not even the GDP of Ireland or the GDP of the City of London, which, by the way, is much higher than the GDP of Ireland. I let out an audible chuckle. I lolled today when I saw the headline that Sunak may want an exemption from this global tax already for the City of London. I mean, if we're already going to start poking this thing with loopholes, how important is it?
Well, that's a good question in terms that we'll look for at the G7 meeting on the minimum tax proposal. I would also point out, though, that even just the idea of this is getting pushback in the U.S. from Republicans, and there have been some warnings in the Senate that this just isn't going to get any Republican support. So clearly, that is one thing to look for at the G7 if the proposals are weakened or if the pushback in the U.S. weakens the sort of rallying cry for those talks. And that seems to be one of the primary points of focus for the U.S., that tax proposal, aside from everything we've heard about from what you can look forward to with Biden's meetings with Putin and Erdogan and non-G7 leaders. But the tax issue and its potential weaknesses will certainly be a focus coming up at the G7 meeting.
Really all about taxes domestically and abroad. Thank you so much to Jack Fitzpatrick of Bloomberg Government. Well, moving on to markets now, and $20,000 Bitcoin. That's what some strategists think could be a new downside target if the weakness in the largest cryptocurrency continues. Let's get more from Bloomberg MLive macro strategist Laura Cooper. Laura, as Matt points out, we're at $34,000 now. $20,000 seems like it would be a very, very sharp move to the downside. Could we really see that?
Well, we could potentially see that. And I think that's just a case of looking back at previous bubble burstings in Bitcoin. The moves tend to be about 80% drawdown. So given the fact that Bitcoin is only about 50% below its April peak, yes, that does suggest that we could see further downside. I think really the latest catalyst around the U.S. authorities being able to recover a ransom does raise questions about the security of Bitcoin. But really at this point, you know, it's going to be quite challenging to really have a new narrative for new money to pile in, because it's really a speculative asset that needs that fear of missing out component to really push higher.
I spoke with Blackstone's Byron Wien yesterday, a legend on the street, but an old legend on the street. He's not a fan of Bitcoin. He says maybe because of his age. Listen in.
Well, 4,500 was a pretty ambitious
forecast at the time I made it at the beginning of the year. And I don't revise those targets during the year, regardless of whether they make me look good or bad. So I'm sticking with the 4,500. I feel pretty confident about that.
Sorry, that wasn't the Bitcoin SOT. That was the S&P SOT. But he did say, in terms of Bitcoin, maybe he's a little bit too geriatric. Nonetheless, getting a lot of pushback on that on Twitter. In terms of the S&P target, look, we're already up 13% year to date, Laura. Is it really bullish? Is he way out front of consensus with 4,500?
I don't think he's bullish. I mean, I certainly think, right now markets are waiting for that next potential catalyst to move higher, and that could yet come potentially from a dovish Fed. We have yet to see what could happen in those inflation prints. But really, I think crucial for markets are those two event risks tomorrow. One is the ECB. It's likely to maintain that dovish tone, that significant pace of asset purchases to continue. And then that US CPI print. Yes, there's a lot of hype around it, but looking at what Treasury rates are telling us, we actually have seen the 10-year now break below its recent trading range at 3-month lows. So this is a market that is looking to have conviction that the Fed, this is really just going to be transitory inflation. So I think we're going to have to see a series of upside price pressure prints really to change that narrative. And I don't think tomorrow could be that catalyst unless, of course, beyond that knee-jerk reaction potentially in real yields and the dollar.
All right, Bloomberg M Live's Laura Cooper talking all things markets. Thank you so much. And let's talk more about the markets and some idiosyncratic stories, stocks moving in free market trading here in the U.S. I want to begin with Lordstown Motors. Of course, the EV startup recently went public via a SPAC, and last night, shortly before the closing bell, filed a going concern warning. Says it may not have enough cash to get through the next 12 months unless it raises more capital. The stock fell about 16% yesterday on that, and those declines continuing this morning, down another 2.25% or so. No declines, though, for some of those meme stocks. The Reddit traders are going at it, talking about a potential short squeeze for Context Logic that drove the stock higher yesterday. That continues this morning. It's up 32% in early hours. And, of course, another meme stock we always keep an eye on is GameStop, the OG, the poster child for this phenomenon. We actually are going to get some fundamentals from the company later on today when it reports first quarter results after the bell. Ahead of those numbers, the stock up about 2% in pre-market trading, Francie.
Yeah, we'll look at that. I mean, GameStop, I think it was up some 6% last time I looked, like 20 minutes ago. So it's definitely volatile or moving, on the move. Coming up next, he's also on the move, Stephen King, HSBC Senior Economic Advisor. I don't know whether he looks at some of these meme stocks, but maybe we'll ask him. We'll also talk to him about inflation. And then later on, to talk G7, Robin Niblett, Director of Chatham House. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
In terms of anchoring solidly medium and long-term inflation expectations around 2%, and we will see exactly what will be the conclusion of the policy review that is ongoing. But it seems to me that we are certainly not at a level where inflation would be a danger in Europe. In the US, it's different. That was Jean-Claude Trichet, former ECB president, talking inflation earlier on Bloomberg. And I was trying to actually remember how many times I've doorstepped Mr. Trichet over the last maybe 15 years. And I think we're looking at thousands of numbers of times in EU summits at like 2 in the morning. And he's always been a gentleman, polite and declining to be doorstepped. Well, joining us now, he's polite enough to actually also come on TV. Stephen King, he's senior economic advisor at HSBC. Stephen, thank you for joining us. Mr. Trichet was basically saying that he's worried the US will overheat, which is a very different problem to what we have in Europe. Should the ECB even worry about inflation at this point?
I certainly think the ECB can be more relaxed about inflation than the Fed can be, which is a kind of statement of the obvious, really, because, of course, we're seeing an awful lot of monetary and fiscal stimulus coming through in the US. We've got the Federal Reserve adopting a new inflation policy, the average inflation targeting approach. So if you were a sort of cautious ECB type, you'd be looking at the US and thinking this is all rather overly experimental compared with what you typically see in Europe. So yes, absolutely, I think Trichet is right to suggest that if there's a risk, it's more on the other side of the Atlantic compared with Europe.
I will never forget former Bloomberg anchor Mark Barton chasing Jean-Claude Trichet down the escalator at Finsbury Square to doorstep him. And at that time, we were always asking about the movement in currencies. Of course, inflation right now is front and center. I've got a great chart here, Stephen, and I'll welcome our Bloomberg radio listeners as well and walk them through what we're seeing here on screen. It's 2 panels, and the top panel is China producer prices. We saw that data come out this morning up to the kind of levels that we haven't seen since 2008. 2009. Now, the interesting thing is the bottom panel, Citi Global Inflation Surprise Index, it tracks with Chinese PPI pretty well. And right now, we're up at a level there that we haven't seen since 2008 either. It begs the question, how important is Chinese inflation as a global driver? What do you think this is going to result in terms of, for example, US CPI, Stephen?
Well, first of all, it begs the question, why are you using the Citi index rather than the HSBC index, which I believe is far superior to the Citi index, but although it does say roughly the same thing. But I would just emphasize that, I mean, obviously what the index is capturing is mostly movements in commodity prices, which are very, very influential in terms of near-term changes in inflation. What I think, however, central banks are worried about is not so much the near-term changes they always say they can look through, but rather the possibility that inflationary expectations and structural inflation rates can shift compared to what we've seen over the course of the last few decades. And what's typically happened over the last 20 years or so is that you get a big increase in, say, oil prices or other commodity prices. It has a near-term impact on inflation. It doesn't last, it doesn't persist. What the worry is now is a possibility that inflation could persistently be higher, and that would be associated perhaps with those experimental monetary and fiscal policies in the US, or maybe because of supply-side disruption, supply chain disruption associated with the end of the pandemic. Stephen, maybe changes in the relationship US and China. All those things may matter.
Stephen, what are you looking for today? We're getting US CPI out and expected to be 4.7% year over year, 3.5% ex-food and energy. how important is this print, and how is it going to affect markets?
Well, I guess if it's lower than that, because what you've quoted, of course, is the consensus view, if it's significantly lower, then people will say we can stop worrying about inflation for the next month or so and see what happens thereafter. If it's much higher, I guess that people will be obviously really concerned that perhaps inflation really is running out of control. But frankly, today's or tomorrow's print is not so important. I think it's more the issue of what happens later in the year and into 2022. If you're looking for a lasting rise in inflation of the kind that we saw, say, in the late 1960s or 1970s, it's that longer-term story that matters. And at this stage, you're not going to see any evidence one way or the other as to whether the central banks are right to be looking through this near-term rise in inflation.
And of course, that CPI print is coming tomorrow, Thursday at 8:30 a.m. Eastern Time. Stephen, when thinking about those central banks and how they are viewing this, what assumptions are you making on when the taper is going to start for the Fed?
Well, so much depends on what happens with the inflation numbers themselves, and also, importantly, what happens with the unemployment and employment numbers. The Fed has put a lot of emphasis on the labor market, basically still trying to illustrate or indicate that there's plenty of spare room within the labor market. But I think one thing that is an uncertainty at this stage is whether the people who lost their jobs during the pandemic will return to the same jobs. Will there be more sort of structurally unemployed? Will there be a rise in the natural rate of unemployment? All those things are the kinds of things that the central banks are having to grapple with currently. And frankly, I think the Federal Reserve, like everybody else, doesn't actually know the answer as yet. And we know from the 1970s that if you have a rise in the structural rate of unemployment, you may find that wage pressures begin to emerge sooner than your models are suggesting.
Stephen, thank you so much. An interesting conversation with some interesting analysis. Stephen King, their Senior Economic Advisor at HSBC. Now, later on Balance of Power, we'll be speaking to Michael Froman. He's MasterCard Vice Chair and former U.S. Trade Representative. That interview, 12 p.m. in New York, 5 p.m. in London, and this is Bloomberg. Europe's financial sector has made some progress with minority and female inclusion, but any momentum has slowed in the wake of COVID-19. I'm Francine Lacqua. We'll take a look at the pandemic's unequal impact on financial services. We'll delve into the data and some of the reasons behind the drastic drop of women in the workforce. We'll also get the views of two very senior women in the industry on creating an inclusive environment, retaining talent, and the future of work. All in our latest Money and Equality special this weekend on Bloomberg Television.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
The curtain will rise again. Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here. Have you
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And in the UK, Chancellor of the Exchequer Rishi Sunak wants London's financial district to be exempt from a global tax deal. Next month, Sunak is expected to make the case that financial services should not be included in a plan to make multinationals pay a minimum corporate tax of 15%. That includes global banks with head offices in London. The U.S. is appealing to Iran to accept what it calls a mutual return to that landmark 2015 nuclear deal. World powers are gathering in Vienna for a sixth and possibly final round of talks. They're trying to persuade Iran to accept a cap on its atomic program in exchange for a lifting of U.S. sanctions. And the U.S. has loosened the travel warnings for dozens of countries, including Canada, France, and Germany. It's a move that could ease airline restrictions for people wanting to go overseas. The State Department changed its warnings for almost 60 countries and territories from do not travel to, quote, reconsider travel. That's after the CDC changed its methodology for its own health notices. Coming up, we're going to have more on the G7 with Robin Niblett, the director of Chatham House. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty
extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lachman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Matt, we talk about inflation, whether it's coming from China or not, but actually, even more interesting, we not only talk about meme stocks, and I think we're waiting for GameStop a little bit later, but Bitcoin left, right, and center.
Yeah, I mean, Bitcoin, because of the volatility, gets as much love as the meme stocks for the same reason. You see the price dropping down. I think yesterday touched 31,000 and change, but all of a sudden everyone's forecasting 20,000, which seems like a big jump, but actually, if you put it into perspective, would only be like a 50–60% drop. It wouldn't be terribly unusual to see that kind of move in Bitcoin over a longer period of time.
No, and this is what we've heard, right? I mean, usually asset prices, I guess, have ranges, but we've always been told, look, Bitcoin could go 20,000 and then to 500,000, depending on a number of things. So I think that's what we're watching out for. And Kaylee, this is all playing out in the markets.
Well, lucky for both of you, I have both meme stocks and crypto in this market check. I do want to talk about the broader equity market first, though, because really, I think we're looking for a catalyst. You're not seeing any major moves. We're down on the stock 600 in Europe by about 0.1%, so coming off of an all-time high. And here in the U.S., we're right around record highs as well, just shy of it, but not a lot of movement in the futures market with S&P E-minis up about 2 points. A little more movement in the Treasury market. You are seeing yields coming down 2 basis points on the 10-year to 1.51%, the lowest level actually since early March. And then, of course, you were just talking about Bitcoin, Matt and Francine, right now around the $34,000 level, so $20,000 does seem like a big jump to the downside, but with this asset class, you really never know. Now, as for those meme stocks, we're no longer talking about the poster children of before, the AMC and GameStop. There's really a new batch of them, one of them being clean energy fuels. It is higher by 42% in pre-market trading. Clover Health by 17%. You also have Workhorse higher by double digits, around 11% right now. And the gains continuing for Wendy's. This stock up 25% yesterday, up another 5% in early hours, Matt.
I hope Wendy's takes advantage of the spike in its stock price and expands internationally, at least to Berlin, because you can't get Wendy's
Matt
here.
Miller wants a Frosty.
We have in London, I believe Terminal 5 at Heathrow has a Wendy's. At least I used to go there a lot when I lived in London. Here in Berlin, it's nowhere to be found.
I think they've redone Terminal 5, Matt.
Yeah, since I lived there, I'm sure they've redone it a couple of times. Listen, speaking of London, I've got a great chart here, and I'm going to walk our radio listeners through it. But I heard reports that Rishi Sunak wanted a break for the city of London when it comes to the global minimum tax today, and I thought, wow, how much does London actually produce in terms of gross domestic product? Well, it turns out to be more than Ireland, and you know, Ireland is the punching bag for European tax criticism. It is smaller than London in terms of GDP. London also bigger than Belgium, which probably isn't any surprise, and Scotland, which definitely isn't a surprise. But it's huge. We're talking about almost 2/3 of $1 trillion in GDP for the city of London, Francine.
Actually, you know what, Matt? So Wendy's is not at Terminal 5. It's not at Heathrow, but they just reopened days ago something, I think, in Stratford, and then they're opening a second restaurant. So maybe Berlin is next on their
Stratford-upon-Avon?
I think it is. No, the other Stratford, closer to London. Now, with G7 finance ministers securing a landmark tax deal, the G7 Leaders Summit in the UK this weekend starts with some positive momentum. But as a group comes together face-to-face for the first time since 2019, many important issues, of course, remain on the table. Bloomberg's Anne-Marie Hordern has a preview.
U.S. relations with traditional allies frayed under Donald Trump. President Joe Biden has vowed to repair this. One area where the group should find common ground, it stands towards China. The world's largest democracies are increasingly determined to combat China's rising influence, be it in so-called vaccine diplomacy or the pace of reducing its reliance on coal. Along with discussing pandemic response and vaccine distribution, leaders will consider climate change, with every G7 nation expressing support of green goals. This meeting offers a chance to craft a strong common message, but the debate over details could expose divisions. President Biden, Italy's new Prime Minister Mario Draghi, and Prime Minister Yoshihide Suga of Japan will be attending their first G7 summit as leaders, while be Angela Merkel's swan song. She's leaving office after 16 years as Germany's chancellor. Her departure will surely alter the dynamic at global gatherings of democratic nations such as this.
Well, for more on the G7, let's get straight to Robin Niblett. He's director at Chatham House. Robin, always a pleasure to speak to you. Thank you so much for coming on. First, do we need to make sure that the EU and the UK actually fix their differences with Brexit and the Northern Ireland Protocol to be sure that G7 can get back on track to talking about things that concern everyone?
Well, I do think they're going to get their problems over the border in the Irish Sea resolved ahead of the summit. I mean, I think we've got meetings going on right now between David Frost, the British negotiator, and his EU counterpart, Maroš Šefčovič, but very tough language in the lead up to it. Some hope, supposedly, that Biden might prevail upon Boris Johnson to make some compromises in return for keeping that strong special relationship in place. And Biden obviously known to be quite supportive of the Irish peace deal in particular. So the question is, can they make sure that this doesn't become a roadblock to a good G7? I think they're going to push off the EU-UK discussion until later in the week. It'll probably get really tough after the G7 summit.
But really tough, and who will have to compromise, Robin? Is it the EU, or will the UK kind of give in with, as you say, a bit of support or maybe pressure from the US?
Look, the problem is that there's no easy way to give in. There's a whole series of cliff edges coming along in the trade that takes place between Great Britain and the Republic of Ireland. And these are going to be hitting literally week by week over the coming months, each month that we see going ahead after the G7 time, right through to October. So it's literally deals about chilled meats. It's how many customs border posts are actually agreed and put properly in place by the British government. These things are literally going to have to be knocked out month by month. And you're not going to have a single moment where everyone says, right, we fixed the Northern Ireland deal.
Robin, I have to ask about the tax deal. People were so optimistic about this and saying it righted so many wrongs and all getting behind it. Now Sunak wants an exemption for the city of London. Pretty soon Germany is going to want an exemption for the Ruhrgebiet, and the U.S. will want one for Silicon Valley. Is this ever going to get done?
I think it'll get done, partly because all of the governments need to be able to show that they are turning the tax system around to one that actually supports the middle class. And this is the big push that we've heard in the Biden administration of middle-class foreign policy. We've seen the same here in the UK with the levelling up agenda. And for the big companies, who everyone knows now are not paying their fair share, as seen by all of the governments. That's what they put out, that message. You can't turn around and not have the success later on. But clearly, each country has got its protected areas. And I think to the extent that the Biden administration seems to be making sure that the tech industries of the US are not unfairly hit, the UK is in right behind it. But in the end, I think there will be a deal done on this front.
You know, yesterday, David Weston on our program, Balance of Power, spoke with the former Taoiseach of Ireland, who said, well, he seemed to be behind the deal as well, but said that Ireland would end up losing revenue as a result because companies would leave. Is there any benefit to, you know, some competition in terms of global tax policy?
Look, I think there's always been benefit to global tax policy. The question is, what is the bottom? And with Ireland at 12.5% compared to a rate which is going to be in the 20s, even into the low 30s around most countries, you've got a level of divergence that allows companies to arbitrage between different markets to an extent that is beyond the competitive advantage and beyond those positives that you can get for competition. So I think that trying to find a floor, which is what you have in any tax system at the very least, even if 15% is low, to get to an agreement that is G7 and, of course, importantly, can then be G20 and then ultimately OECD, so it actually captures a large enough market, would mean you still have plenty of room for competitive play above that 15% minimum, and maybe that 15% might become 18 in the future, but you don't have the leakage and the spillage and the deep frustration this is causing for governments around the world because their publics are really upset.
Well, can we just characterize the strength or weakness of the position of the Biden administration coming to discuss this issue a day after talks on bipartisan infrastructure plan with the head Republican negotiator collapsed here in the U.S., taxes being a big issue and getting a bipartisan agreement? How difficult is it for the Biden administration to push for a global minimum tax when they can't even find consensus domestically?
It's every government. I mean, tax is the issue that is at the core of your domestic policy. It's the area where in the EU, there is pretty much no central competence at the EU level because each government is hanging on to its own tax policy as much as it possibly can. So every government is weak at some level going into this. And we're going to see in the coming months, each government having to do compromises. The reason I'm optimistic is in a way each one needs the other to be able to strike the deal. Each side needs to be able to show that somebody else is moving to have leverage back at home. The idea that you can come forward from a strong domestic position, for example, President Biden, there was already doubts here in London that the tax deal we would need to get through Congress to be able to do market-based tax systems, taking those extra 20% above the 10% profit-making threshold. That's something that would have had to be passed by the US Congress in any case. Right. So at the moment, we're in a dance, and I think it's just too early to be able to give a clear picture. As I said, I'm still convinced we'll get a deal done at the end of this.
Of course, the U.S. and the U.K. are both in a relatively stronger position on the vaccine front, and President Biden and Prime Minister Boris Johnson have been really out front in pushing for Western countries to share their vaccine stockpiles with the developing world. Are other European nations going to support them in that effort?
I think definitely. The UK, you could say, and the US are late to the party on making these commitments. They've made the commitments to COVAX, to the global vaccine providing authority for developing countries around the world. But in terms of actual delivery, they've been behind the curve. The EU has been able to make the point that it has been one of the big exporters of vaccine, partly because of the manufacturing that takes place there. But they've also been making their own commitments to be able to get vaccines out, in particular to sub-Saharan Africa. If Africa goes wrong, Europe in particular is going to feel it. If there's a big outbreak there, as there's been obviously the huge outbreak in India and in parts of Latin America, if Africa goes in that direction as well, you're going to get a huge amount of pressure, adding to migration, adding to instability. So I think actually the EU and European governments will be strongly behind the push that Boris Johnson and President Biden will be making. As I said, they've got a lot of the credit for it, but they haven't made the move yet.
Robin, what happens to China if at the end of the day, we find out that COVID was actually made in a lab?
Well, we will never know for sure, I think, because the Chinese government will make sure that you will never know for sure if that turns out to be the most plausible theory. So the problem here is more about how untransparent is China going to be about the exact origins, in particular these reports that at least 3 of the lab technicians actually came down with some type of respiratory disease back in November of 2019. If these stories are not effectively addressed, it's going to add to the level of suspicion about China. But ultimately, there are so many other deals that we're trying to strike right now, as we've discussed in this conversation. China needs to be part of a global tax deal. China needs to be part of a COP26 agreement in November at the end of this year. China's probably going to be part of the answer to development in Africa. And ultimately, most companies in America and in Europe are trying to get on the back of the Chinese growth engine. So China's not going to give in on this. And I think what it does is it firms up the solidity of Western countries and taking a much tougher line towards China, but it's not going to be the final element that pushes into some type of new economic Cold War. It's just going to be messy and unclear.
Robin, thank you so much. Robin Niblett there, director of Chatham House, with a number of questions on a number of topics. Now, later on Bloomberg Surveillance, we'll discuss more on the G7 summit with Eurasia Group president and G0 media president Ian Bremmer. That's at 6:30 a.m. in New York, 11:30 a.m. in London, and this is Bloomberg.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shakeup, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
This is Bloomberg Surveillance Early Edition. You're looking.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacroix in London and Kaylee Lines still in New York. Now, Bitcoin is gaining some ground today, but it's been a tough week for the OG of cryptocurrencies. It's led some strategists to eye $20,000 as a new downside target. That would be, what, 75% off from where we are right now. Let's get more from Bloomberg MLive's Eddie Vanderwalt, who has been following cryptos for the past couple of years very closely. And Eddie, what do you see in terms of the possibility of a move down to 20,000? I guess it's not entirely outside the realm of possibility, considering the volatility we've seen with this asset.
Oh, absolutely. I think, look, over time we have seen that Bitcoin is capable of significant drawdowns as well as significant upside. And, you know, that's what a lot of people love it for, this, particularly this volatility. But, I think we're starting to see a flaw, which is not really what we have seen in previous cycles. In previous cycles, what we saw was when you see the run up, it goes parabolic. And when it comes down even more sharply. This time around, it feels like it's, a little bit more controlled on the way down. Now, we'll see whether that remains the case in the coming weeks.
Eddie, is it right to look at some of the technical support, that we've seen with other asset classes with Bitcoin, or is Bitcoin just in a class of its own?
I think, to be honest with you, I think technicals is absolutely the right way to look at Bitcoin. Because Bitcoin, don't forget, it trades almost exclusively on animal spirits. And that is what technicals try to measure. It tries to measure, when we see, when there is momentum in a stock, when people are getting excited about it. And this is what you try and measure. And so over time, I think I've seen some of the best predictors of cryptocurrencies have been the technical analysts. Certainly the fundamentals are a lot harder to call.
That's the technical side, Eddie. What about on the correlation side? Your colleague on the MLive blog, Mark Cranfield, put out an interesting post overnight about the correlation between Bitcoin and the Bloomberg Dollar Spot Index, essentially saying you have to see the dollar recover in order for Bitcoin to gain any kind of traction here. If we get the weaker dollar story that everybody's calling for, what does that mean for Bitcoin?
Yeah, I think Bitcoin has become much more of a risk-on play of late. I think that's a good thing for Bitcoin, right? Because as you see more institutional money flowing into it, it will start to correlate with other assets, which it never had been in the past. So look, I think if we see, tech stocks selling off, I think that would be really damaging for Bitcoin. I think at this point, Bitcoin is trading a little bit like a tech stocks, but one with, significantly higher volatility.
What do you see in the other cryptos? A lot of people get down on Bitcoin because of transaction time and costs and its lack of abilities that, for example, Ether has. Are other coins rallying while Bitcoin falls, or does the, I guess it's not a rising sea raises all ships, but a falling tide brings everyone down?
Right. Right. If you pull the plug out of the bathtub, everything sinks down, right? I get it. I agree with you. And look, absolutely that is the case. What we're seeing right now is the wider space is falling alongside Bitcoin. Ethereum's slightly outperforming year to date, but I think you need Bitcoin to do well, to bang the drum for the cryptocurrency space and bring new investors into the space. And if you don't see that, we saw that in 2017 and we saw it in previous cycles. You do see the other cryptocurrencies come back down if Bitcoin comes down.
All right, thank you so much. Eddie van der Walt there, our MLive superstar, actually talking about everything from Bitcoin to
in the office too, which is cool.
In the office, it was exciting for us as much as it was for him. Now, coming up a little bit later, former TD Ameritrade Chief Executive Joe Molia. That's at 1 p.m. in New York, 6 p.m. in London, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman in London, Matt Miller in Berlin, Kaylee Lyons in New York. Now, Tom Keene, co-anchor of Bloomberg Surveillance. I say it every day, Tom, but everybody knows what you anchor and who you are. What are you looking at?
I know
So
you and I are in
G7
therapy.
with some star guests. I'm winning the therapy.
We've got some wonderful guests today. Of course, President Biden heading over to your space. He's doing a poldark. He's going to Cornwall. And, Francine, we start strong on American capitalism with Luigi Zingales. You know him well from Italy. We will not speak Juventus football with Luigi Zingales, but looking forward to his discussion on America. Ian Bremmer will be with us as well. Really looking forward to that as he assesses a G0 world and President Biden's first trip abroad. On the chart, let's go narrow, Francine. This is our ace reporter in Hong Kong, one Tanya Chen, writing up a cross rate that I've never done before. This is what I love about Tanya Chen's work, is it's totally obtuse. Taiwan dollar versus Korean won. And I didn't know this. Taiwan dollar has been hugely strong versus Korean won over decades and decades, and again, it has strength right now.
Yeah, well, congratulations to our Tanya Chen for a wonderful article. And also,
I didn't understand it, but other than that, it was great.
Yeah, you need a PhD to understand it. I know you want to ask Luigi about Juventus, but you must ask about the European Championships starting next week.
I have been told about this. I may have. I got an invite from Alan Ducas's restaurant to go, Francine, and watch France-Germany. Should I do this?
I mean, I'd watch Italy, France. That's where there's a tension, certainly in my household. But Germany, maybe Matt Miller will disagree. This is what else we're watching for. Kaylee, what's on your radar?
Bank of Canada decision at 10 a.m. Eastern time, expected to kind of continue to lay the groundwork for a tightening of monetary policy, that path toward normalization. And yes, it's not a G3 central bank, but could G3 central banks follow what the Bank of Canada does? That's why I'm interested, Matt.
I am watching Ferrari. We already discussed the fact that they've got a new CEO, but they took him from a chip maker. You're going to look at here pictures of the SF90 Stradale. This is a 1,000 horsepower hybrid, but here's to hoping Ferrari sticks with the naturally aspirated engines. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think the sort of reopening has a long way to go.
We actually think the markets tread water for a bit as we continue to be concerned about inflation and taper talk.
It's very likely that we won't have certainty around the underlying inflation process until we're well into next year.
The inflationary pressures that we're seeing will abate, but I think we are in a pretty unique period of monetary policy.
We have a real recovery in process. I don't think the roaring 20s are the right analogy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. Interesting markets today. Leaving on a jet plane, the President of the United States. We will look for him to leave the White House this morning, but a lot of market action as well. Matthew Miller in Berlin doing yeoman's duty in for John Farrow this morning. Lisa Abramowitz, Brent crude almost to 73, but I've got to pay attention to new yields testing lows, and that is a 10-year yield. We almost got a 149 handle.
This, to me, is the story in markets, especially ahead of the CPI print tomorrow in the United States. The idea here that we're expecting inflation to tick up. You have increasing numbers of warnings from top economists and former Fed officials that the Fed is going to get too far behind the 8 ball and is going to commit a policy error. Inflation, what could we go back to? And here we have yields that are near the lowest levels since at least March, if not further back. Tom, the bond market has spoken. They are not concerned about higher inflation.
Are they vigilantes? Matt Miller with us with the vigilantes in Berlin. Matt Miller, I look at the Swiss 20-year as my European benchmark, and it is revisiting, not there yet, but getting back near negative rates again. You had Jean-Claude Trichet in the last hour. What did he say?
Well, I haven't talked to Jean-Claude Trichet in the last hour, but Francine, I believe, did early this morning. It's interesting, you know, you asked me if there was a euro level that would make people scream, and every time I hear someone talk about euro levels, I always think of the famous Trichet doctrine, which is it doesn't matter where it is, it just matters how fast it gets there. And right now, we've been seeing euro float comfortably around 121, 122 for quite a long time.
Well, the euro dynamic there in the ECB meeting, of course, of import as well. Lisa, I know you're going to do it in your brief, but we've got to go to it. The symbolism of a president to the United Kingdom.
The idea here that President Biden is going to take his 2-week tour of the full world and basically set his grand tour and set out his global agenda at a time when there's such domestic uncertainty with respect to policy. I am wondering how much he'll be able to shore up support from the allies, especially after the move that the U.S. made to shore up the tech sector in particular to compete with China yesterday with that bill.
Well, the different views from Europe, I think of President Trump and some of the controversy there, and certainly meeting with the Queen of England. But Matt, it goes back to President Obama and that historic visit to Berlin many, well, it seems now many years ago as well. How would Mr. Biden be greeted across Europe, across the G7, Matt?
I think, you know, right now it's difficult to gauge because of the damage that Donald Trump has done to the relationship between Germany and the U.S. But Obama was so beloved here that some of that has to have rubbed off on his then vice president.
Well, we'll show you some of those images coming up later. Of course, the president beginning from the White House as he travels to Cornwall as well. We're looking at the markets today. Lisa, help me out here with the markets with the red and green on the screen, but a shockingly resilient equity market over the last number of weeks, really buttressed up near record highs. Lisa, tell Tell me about fixed income.
Well, basically, the 10-year yield, you nailed it. It's 1.5%. This comes off after people have been expecting the 10-year yield to get to 2% by year end. We're not even close. We're going in the opposite direction. Actually, and I know you're focusing on this, Tom, the real yield has gone more negative. So this is not necessarily because people are ratcheting back inflation expectations so much as expecting the Fed to remain easy and remain in there, which we will see today. Also, crude, I think, is fascinating. The fact that we're seeing the highest levels since 2018. This comes from Iranian nuclear accord deals and a whole host of other potential demand factors. If you've got on an airplane and see how crowded it is, that might give you a hint. All right, as for what we're looking at, the economic data ahead today, 10 a.m. we get U.S. April wholesale inventories. Interesting to see a gauge of what potential orders may be like going forward, especially with all the shortages in commodities and other supplies. 10:30 a.m. going to the crude story, EIA crude inventories. Very interested to see the drawdown in U.S. supplies. How much is that going to increase some of the production in shale producers? That's really the wild card that so many people cannot quite figure out right now. And at 1 p.m., the U.S. is planning to sell $38 billion of 10-year notes. Again, who is going to come in to buy? Probably everyone, gauging from the 1.5% yield you're seeing on the 10-year. But honestly, there is a question of how much longer this demand can continue with the inflationary outlook and with the incredible supply coming online.
We're going to have a lot of market coverage here through the morning, but in this hour, we really frame out the president's trip, and we start incredibly strong in this hour. Ian Bremmer scheduled to be with us later on, but right now, Luigi Zingales with us from Italy and from the Booth School of Chicago, and I really can't say enough about his podcast, Capitalism, and also, of course, A Capitalism for the People, his wonderful book, a really different view on the American economic and political experiment. Professor Zingales, thank you so much for joining us this morning. How will President Biden be greeted in Europe?
I think that Matt was right. He's greeted very nicely just because he's not Trump. I think that Trump did create a long-term friction, and some of that can be fixed by just not being Trump. But I think that there is a longer-term concern of whether the U.S. policy and the European policy are aligned in the future. And I think that the giant in the room is, of course, China, and the policy that Germany has in mind and indirectly Europe has in mind for China is very different from the policy that the Biden administration has in mind. So I think that there is a risk for conflict there.
Luigi, what do you expect to actually come from these meetings with European allies with respect to China policy? What are you hoping could get accomplished that will actually tell you something concrete?
Honestly, I don't hope. I don't expect anything to take place. I think that Germany wants to maintain very strong trade relationship with China, and is not going to do anything to jeopardize those. And and I think the United States would like a stronger voice on human rights and also on trade policy in general. So I don't see much of a space for agreement there.
Has Germany become somewhat of a problem here, Luigi? I mean, Berlin wants stronger ties with Beijing, and Berlin also wants to send money to Moscow via the Nord Stream 2 pipeline. It seems like the Germans are not willing to let go of a lot of U.S. adversaries.
In part is that the Trump presidency represented a fracture that is difficult to undo. Germany realized that cannot rely longer term on the relation the same way that used to. And so I think he started to craft a European policy. The problem is that there is not really a European state, let alone a European army. So I think it's going to be a bit of a challenge there, because if Europe were to speak with a common language and a common message, I think would be one thing. Unfortunately, in foreign policy, we still are pretty fractured.
Luigi, on your take on American capitalism, where is our capitalism now with the dominance of these technology companies? President Biden's dealing with it. Our radio, our TV listeners and viewers, each of us is dealing with this technological revolution, whether it's Amazon, Google, or things we don't even understand. How will our capitalism survive that?
So I think it's a mixed view. On the one hand, technology has brought us an enormous amount of benefits. I think it would be hard to imagine the life under the pandemic without the technology that was provided, from the Zoom we're using to the Amazon that deliver our food to our doorsteps and so on and so forth. So there is no doubt that there have been enormous improvement, enormous benefits. The concern I have is that the market is becoming more concentrated and less contestable, and more importantly, that these companies can pretty quickly have also some power in determining what we see, what we read, what we do. And when you start to have such large market power, the concern is that you might use it not only for economic reasons, but also for political reasons. So I think that there is a concern that is not just about the economic effects of concentration, but also the political effects.
There's a quick question, Luigi, about the dynamism of the economy with concentration at the top and then highly indebted companies that have more legacy businesses making up the remaining economy. Do you think that the economy that you're describing here with the concentration of big tech is less dynamic and poised for slower growth?
I think there is the risk that is less dynamic, and I think that that's where, in my view, one of the direction of the antitrust should be. In my view, I know this is a disputed view, but in my view, the trial against Microsoft in the late 90s was very useful to provide a space for the current technological revolution. I think that if Google exists today, in part, is because the DOJ sued Microsoft. So it's only fair that the DOJ would sue Google to let the next Google come about.
Luigi, you got to leave it there. Luigi Zingales, thank you so much. Really look forward to you coaching Tottenham here in the coming weeks. He is from the University of Chicago, Booth School, and of course, I can't say enough. It was book of the summer a number of years ago on capitalism. Lisa, there's the most important headline of the day. Wells Fargo, Sarah House, and the rest of their team lift all year 2021 GDP to 7.5%, I should say. Wow. That's a huge deal.
And how does this cohere with bond yields of 1.5%? I mean, just going to the point that you were making earlier, they're not the only shop, right? I mean, they're not necessarily the top call in terms of 2021 GDP at this point, but still you could see it just creeping higher and higher.
This is so important. We had GDP was going to fall off a cliff. We were all going to die. And we're really beginning to see a readjustment up here to 7.3% in this case.
Yeah, I mean, look, I talked to Byron Wien last night. He forecast at the beginning of the year, really at the end of last year, that we would see stronger growth than 6%. And he's been spot on with a lot of those annual surprises.
Yeah, that's been a real partition, folks. Forget about the market talk. Just getting the GDP call right has been a battle. This is really exciting. Lots going on. A pageantry at the White House as the president leaves for the G7 meetings, and also lots of market action. Brent crude, 72.47. Lisa Abramowitz's Hummer. It's going to cost a fortune to fill that puppy.
Oh, yeah. Huge.
Stay with us. This is Bloomberg.
With the First Word News, I'm Rich Gigup. They call themselves the Problem Solvers Caucus. And the group of House Democrats and Republicans has come up with a plan to break the logjam over infrastructure spending. Last night, they agreed on a total spending package of $1.2 trillion. President Biden has called for a $1.7 trillion plan. But yesterday, he ended talks with Republican Senator Shelley Moore Capito after they failed to reach an agreement. And the Senate has overwhelmingly passed a bill to help the U.S. compete with China. It calls for investing almost $250 billion to bolster manufacturing and technology. It was a rare spot of bipartisanship in an otherwise polarized Senate. Still, the bill's fate in the House is uncertain. The U.S. is appealing to Iran to accept what it calls a mutual return to that landmark 2015 nuclear deal. World powers are gathering in Vienna for a sixth and possibly final round of talks. They're trying to persuade Iran to accept a cap on its atomic program in exchange for a lifting of U.S. sanctions. And in the UK, Chancellor of the Exchequer Rishi Sunak wants London's financial district to be exempt from that global tax deal. Next month, Sunak is expected to make the case that financial services should not be included in a plan to make multinationals pay a minimum corporate tax of 15%. That includes global banks with head offices in London. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We're pursuing a two-path proposal. On the one hand, there's bipartisan negotiations, and those are continuing. The first were between President Biden and Senator Capito with just Republicans. Those seem to be running into a brick wall.
The senator from New York with a little bit of experience out there. He is the Senate Majority Leader, and he is not happy, and we will have to see how that unfolds today. Excuse me, we'll get to that in a moment. Ian Bremmer is scheduled to be with us here in a moment. We'll talk to Dr. Bremmer about the president's trip. Right now, Jack Fitzpatrick with us from Bloomberg Government, Matt Miller in Berlin, and for John Farrell, Lisa Bramowitz with us as well. Interesting markets. And Jack Fitzpatrick, I guess last evening when things happened in Washington, bipartisan ended. What does that mean for President Biden that bipartisan ended?
Well, bipartisanship is not necessarily entirely dead, but it did end in the way it was going before. President Biden was negotiating with Senator Shelley Moore Capito. After an extended back and forth, he told her he was going to cut those conversations off because she wasn't offering enough money on behalf of Republicans. There is another bipartisan group of senators that is trying to cast itself as Plan B, about half a dozen who are trying to negotiate a plan among themselves, and then they'll pitch it to a larger group. So there is a bipartisan plan, and it's more of a Senate contained series of negotiations. We'll see if that works out. Of course, if Senator Capito couldn't get something from Republicans that Biden thought was satisfactory, that's not a good sign. So we have heard from a number of Democrats that they would like to start to prepare for budget reconciliation, which is